In today's video, I'll cover the most effective strategies to help high-income earners reduce their W-2 taxable income in 2024. I hope it may help you to grow and save faster than you think. So, let's start. Section 1. Why do W-2 employees pay more taxes? As a W-2 employee, your taxes are based on your total income before any deductions, known as gross income. This means taxes are taken directly from your paycheck before you have a chance to spend or save any of it. On the other hand, business owners and investors are taxed on their income after expenses. They get to withdraw their costs, which lowers the amount they pay taxes on. For those who are making a lot of money, this difference makes a big difference. In 2024, individuals earning over $609,350 or married couples making over $731,250 are taxed at the highest rate of 37%. Even if you earn more than $200,000, you are in a higher tax bracket, meaning more of your income goes to taxes compared to those who can claim expenses. Understanding how taxes work can help you plan smarter and save more. Section 2. Max out your pre-tax 401k. Now, let's get into some practical strategies. One of the easiest ways to lower your taxable income is by maximizing your pre-tax 401k contributions. In 2024, you can put up to $23,000 into a traditional 401k. If your employer offers a matching contribution together with your own, the total amount can go up to $69,000. The great thing about these contributions is that they come out of your paycheck before taxes, which means less of your income is taxed for the year. You can choose between two types of 401k accounts, traditional or Roth. With a traditional 401k, you don't pay taxes on your contributions now, but you will when you take the money out during retirement. In a Roth 401k, you pay taxes up front, but the money you withdraw in retirement, including any growth, is tax-free. Section 3. Mega-Backdoor Roth Strategy. If you're looking to save even more beyond the 401k limits, you might want to explore the Mega-Backdoor Roth Strategy. The Mega-Backdoor Roth allows you to go beyond this limit by contributing after-tax dollars and then converting them into a Roth account, where your money can grow tax-free. In 2024, you can contribute up to $69,000 in total to your 401k, but only $23,000 of that can be pre-tax. Here's how it works. Suppose you've reached the limit for your pre-tax contributions. You can still contribute more, up to the total limit, with after-tax dollars. Once you've made these after-tax contributions, you can roll them over into a Roth 401k or Roth IRA. The big advantage here is that any money in a Roth account grows tax-free, and you won't have to pay taxes when you withdraw it in retirement. This strategy is great for people who want to save more than the usual 401k limits and enjoy the benefits of tax-free growth in a Roth account. Section 4. Maximize your health savings account, HSA. Another great option for tax savings is the health savings account, HSA. It offers 3 tax benefits. Your contributions are tax-deductible, any growth in the account is tax-free, and you don't pay taxes on the money you take out for qualified medical expenses. This makes an HSA a great way to reduce your taxable income while also saving for future healthcare needs. In 2024, you can contribute up to $7,750 if you have family coverage, and $4,150 if you have individual coverage. If you're over 55, you can add an extra $1,000 as a catch-up contribution. All of this money is deducted from your taxable income, helping you save on taxes for the year. To get the most out of your HSA, consider saving the money for the long term instead of spending it right away. Some HSAs allow you to invest your balance in mutual funds or other investments, which can help your savings grow tax-free. By letting your HSA grow over time, you can build a large fund for future medical expenses or even use it as extra retirement savings, all while enjoying the tax advantages. Section 5. Flexible Spending Account, FSA. If you want more ways to save on healthcare or dependent care expenses, consider using a flexible spending account (FSA). It is another great way to lower your taxable income while saving for healthcare or dependent care costs. In 2024, you can contribute up to $3,050 for healthcare expenses and up to $5,000 for dependent care through a dependent care FSA. The money you put into an FSA comes out of your paycheck before taxes, which means your taxable income for the year is reduced. However, FSAs have an important rule to remember. They are use it or lose it. This means that if you don't use all the money in your FSA by the end of the year or within your plan's grace period, you'll lose any leftover funds. So, it's important to carefully estimate how much you'll need for medical or dependent care expenses before deciding how much to contribute. Section 6. Deferred Compensation Plans. For high-income earners, deferred compensation plans offer a way to delay part of your salary or bonuses to a future date, like retirement. It is a useful tool for high-income earners who want to lower their taxable income now by delaying part of their salary or bonuses until a future date, like retirement. By doing this, you reduce your taxable income for the current year, which can help you avoid being taxed in a higher tax bracket. You'll pay taxes on the deferred income when you receive it, ideally when your income is lower, such as during retirement. The main advantage of a deferred compensation plan is the potential tax savings. As an example, if you're in the 37% tax bracket now, but expect to be in the 24% bracket later, deferring some income means you'll pay less in taxes when the money is eventually paid out. Plus, many plans let you invest the deferred money tax-free until you receive it, which can help it grow over time. However, there are some risks. Unlike a 401k, deferred compensation isn't protected if your employer runs into financial trouble. If your company goes bankrupt, you could lose the deferred income. Also, if you leave your job, you might receive the deferred money all at once, which could push you into a higher tax bracket that year. Section 7. Equity Compensation Management. If your compensation includes stock options, managing them effectively can also reduce your taxable income. Let's know some stock options you might adapt. RSUs, restricted stock units. Taxed as ordinary income when they vest, when you own the shares. Gains from selling them later are taxed as capital gains. ISOs, incentive stock options, offer favorable tax treatment. If sold before holding for 2 years, it may trigger alternative minimum tax, AMT. Held for more than 2 years, taxed at the lower long-term capital gains rate. NSOs, non-qualified stock options, taxed as ordinary income when exercised, based on the difference between exercise price and market value. ESPP, Employee Stock Purchase Plans, allows buying stock at a discount. If sold within 2 years, gains are taxed as ordinary income. Held longer, gains taxed at the lower long-term capital gains rate. Section 8. Real estate strategies for reducing taxable income. Investing in real estate is a great way for high-income earners to reduce their taxes. One key benefit is depreciation, a tax deduction that reduces your taxable income by accounting for the wear and tear on your property over time. Even though it's a non-cash expense, depreciation can help lower the amount of tax you pay on rental income. You can also follow another strategy, which is the 1031 exchange, which lets you sell an investment property and reinvest the money into a similar property without paying capital gains taxes right away. This allows you to keep growing your real estate portfolio while delaying taxes on any profits. Section 9. Charitable Contributions for Tax Deductions. Donating stocks or other appreciated assets can give you 2 tax benefits. You avoid paying capital gains taxes on the increase in value, and also get a deduction for the current market value of the donation. Using tools like donor-advised funds or charitable remainder trusts can make the process even more tax efficient. Besides, bunching donations, which means combining multiple years' donations into 1 year, can help you go over the standard deduction and get more tax savings. These strategies can make your charitable giving even more beneficial for your finances. Section 10. Final tips. Maximize other deductions. I must tell you this simple thing that many people don't think much about. Don't forget about simple deductions like mortgage interest and property taxes, which can lower your taxable income if you itemize. You can also deduct medical expenses that are more than 7.5% of your adjusted gross income. For high-income earners, think about using a non-qualified deferred compensation NQDC plan. This lets you save extra money beyond your 401k limits and delay paying taxes on that income until later, when you might be in a lower tax bracket. At the end, I just want to say one thing before ending the video, is that plan smartly, use every strategy, and keep more of what you earn. And don't forget to like, subscribe, and share for more expert tips. Have questions? Drop them in the comments. We'd love to hear your thoughts.